and thank you for inviting me and PGIM to speak today on this webinar. I really want to focus on our views on the fixed income market, starting with the macro economic landscape, obviously what's happening with the latest inflation trends, what that means for the Federal Reserve and short-term interest rates, what it ultimately means for long-term interest rates, which is what really matters to you and your clients. And then I'll touch on the credit market trends we're seeing, and I'll try to tie in what we're doing in our portfolios that we manage on behalf of you and your clients. As you know, our flagship is our total return bond strategy. I know you have the Great Gray Total Return Bond Fund on your platform. I know we've negotiated through the great partnership between PGIM and RPAG, a great fee on behalf of your clients. I think it's 25 basis points or something for a core plus strategy that's trying to beat the Bloomberg Ag by about 150 basis points a year gross over the long term. We've actually been very successful achieving, or at least getting close to achieving, that goal over many, many years. Really strong, stable performance. We've done it with a team of tremendous resources. We're probably the best resourced public fixed income asset manager in the world. We have about 140 credit analysts who really focus on solid underwriting. That is, picking bonds that are going to pay us back and generate expected returns above your typical risk-free assets. That's really our bread and butter. But we also encompass our portfolio construction with a really diligent in-house, fully proprietary risk management approach that ensures that the return series is a little more stable and expected for you and your clients, so there aren't any big surprises. I know we're really benefiting from some turmoil in the fixed income market, not only among peers, but also in light of the really high level of interest rates, attracting a lot of flows into our whole suite of funds. And thank you again for your partnership and providing the support and working with us to really provide what we consider one-stop shopping for your clients, right? Our total return strategy, again, is really a great way to access a high-quality, liquid, U.S.-centric, intermediate-term fixed income exposure, again, with a pretty strong alpha target and a really smooth ride over time. So that's really our bread and butter. So enough of that. Let me jump in to the markets. From a macro perspective, every day we're getting data. We just got some jobs data from JOLTS, and it seems like, every time things look like they're rolling over, you get another kind of boost of resilience, at least in the U.S. economy, right? We've been a little skeptical about how long we can continue to grow in the 2 to 3% range, but we are there now, right? We are growing in the U.S. in terms of real GDP, in the mid to high twos, if not close to 3% right now. And we've been running at that really since COVID. We've gone through what I call a nominal GDP boom. If you take the real growth and on top of that, the inflation, nominal GDP in the US has increased over 40% just since the bottom in COVID, just a handful of years ago. So think about that. We've gone from a $20 trillion economy to an economy that's now close to 30 trillion in size on a nominal basis. That's the biggest increase in nominal GDP we've seen in this country since just after World War II. So we have gone through a post-war, post-pandemic boom in this country. And it's actually supporting credit conditions. It's supporting a lot of the debt because, the nominal GDP is what you really generate revenues with and taxes with to support debt. So believe it or not, I'll touch on the fiscal side in a second. But if you look at our federal debt relative to GDP, it's actually been coming down since the peak in COVID because the denominator is growing so fast. But I'll touch on that in a second. Our view, though, is that growth is probably poised to slow. And it's really probably three primary conditions, right? One is I think the level of interest rates, and actually the Fed will agree. You've seen a few Fed governors come out in the last day or two, and they're all saying the same thing. The funds rate, monetary policy is restrictive right now, right? We're still kind of in the high fours in terms of the federal funds rate. Inflation is kind of bouncing around in the mid twos. That's a really big positive real rate, and that is viewed certainly by the Fed and me and us as being pretty restrictive. And they know they have to bring that down over time. But with the economy continuing to be resilient and pockets of inflation that arguably are a little sticky, they're probably going to be slower to bring that down than we would have guessed just 6 or 12 months ago. So I think that tight monetary policy will start to weigh on growth and just the ability for consumers and companies to service the high level of interest rate on their debt. Secondly, consumers are running out of bullets. I mean, there's no doubt what we're seeing as we go through all of the retailers' earnings. I talk a lot with our retail analyst team, our consumer products research teams, and it is a clear sign of down trading, right? Consumers have kind of run out of all the excess savings they had during COVID, and they're kind of running on fumes now, right? And the high price level of everything from rent, to gas, to insurance, to cars, to food, to you name it. It's getting to the point where people, and I'm not talking a small cohort. I'm talking 80% of the population kind of running out of discretionary excess income to buy goods and services that aren't absolutely mandatory. So you're seeing this big trade down. One of the great stats with this recent retail earnings reports, 2/3 of the growth in retail sales that we're seeing in the country right now are coming from three providers: Amazon, Walmart, and Costco. All right. I know I'm a fan of all of them because they are deep value providers, and people are trading down. I mean, they're trading down from regular supermarkets, to Walmart. They're trading down from, typical department stores to Amazon. They're trading down from Target to Walmart, right? And they're going to where the value is, where they can get the most bang for your buck. And you all also are seeing debt levels, credit card usage, obviously student loan payments are becoming a problem again really quickly. Mortgage payments and the interest rate on your mortgages have gone up. It's really starting to take a bite. So it just feels like a matter of time before consumption slows and economic growth kind of, instead of running in the mid to high twos, probably takes a percent or 0.5% bite out of it and maybe end up in the mid to high ones or 2-ish% GDP growth, which is not terrible. A lot of economists would say that that's kind of potential GDP, that's a pretty good trend rate of growth. And I would agree. But I think this really high level of growth we've been seeing is probably mostly behind us, and we'll see a little slowdown. The third factor is what's happening around the rest of the world. I mean, just this morning, you're seeing, problems in Korea, right? China is really struggling. They're trying all kinds of stimulus, and their economy is really in trouble. The European economies are kind of on their back to some extent. So you're seeing all kinds of not only geopolitical risks in the world, but just macroeconomic growth problems around the world. And it's just, again, difficult to see the U.S. really continuing to be this island of resiliency among a slowing macro backdrop globally. But the good news is I think the probability of recession or a hard landing, meaning, what we think of like as an existential credit crisis where you have a big spike in default rates. I mean, you're seeing defaults go up for sure from low levels, from consumers, small businesses, companies. The default rate in the leveraged loan market, and all those companies are paying floating rate debt, right? Those default rates are going up pretty quickly. So it's happening, but we don't expect one of these, financial crisis, COVID type level of problems in the real economy, right? It's probably going to be a soft landing or just a very, very shallow recession in our mind. And remember, even if you do have an exogenous shock that causes a temporary shutdown in activity or a hard landing, you do have a central bank that has hundreds of basis points of dry powder. And it's not just the Federal Reserve of the US, right? Central banks around the world have really high interest rates and a lot of scope to support the global economy. So that's kind of a nice backstop there. So turning from the macro to the inflation quickly, I mean, inflation is falling, right? The high level of prices, again, they're so high that they're just really unsustainably high. And ultimately, if those prices just stop going up and stay at a really elevated level for the next couple of years, the inflation rate, as you know, mathematically goes to zero, right? The rate of change goes to zero. And I wouldn't be surprised. And we're already running kind of, we've gone from 5 to 4 to 3. We're kind of running in the twos right now in inflation. If you look at, PCE, core PCE, it's kind of in the low twos. If you look at headline CPI and core CPI and just strip out the housing component, which is arguably, and certainly in my mind, a little bit of a lagging indicator. And I think housing and rent growth rates are slowing. You're back to like just about a 2% level of inflation year over year, right? Goods prices are negative. Discretionary goods are negative year over year again. A lot of commodities are negative, notwithstanding some of the precious metals, et cetera, are negative year over year, right? So you're kind of in a supportive inflationary environment. I think you're going to kind of continue to grind to 2. Maybe you get stuck at 2.5 for a couple of years. But there's a risk scenario that we talk about and we think about as a pretty reasonably high probability where one day we wake up in 6 or 12 months and instead of having 3 and 2 handle inflation rates, we have 1 handle inflation, right? And again, it's just the price level not going up anymore. And you can pretty easily see if you get a continuation of the pullback in consumer spending and maybe business spending follows suit, you could easily see, 1 handle, God forbid, 0 handle inflation rates in the next 6 to 12 months, right? So don't discount that probability. I know it's very easy to fall into the trap of the current paradigm. You're saying, oh, well, inflation's sticky, it's sticky, it's sticky until it's not, right? And it went up really fast and it can come down pretty quickly when you have a lot of pushback on the high level of prices. I mean, food prices, believe it or not, since the peak about 2 years ago, are down almost 25% globally, right? They went up 80%, right after COVID, and now they're down from that peak. They're still up 30% over 5 years, which is a lot for people to handle, right? It's a lot more than wages have gone up. But don't discount the idea that heck, maybe inflation comes down. So that puts the Fed in a position where, again, I think the funds rate is too high. I think it's supposed to be probably 4% right now. And I think they're going to get there, right? More and more of the governors are coming out talking about cutting in a couple of weeks at their December 18th meeting. The markets it's kind of a crapshoot. It's like a coin toss for the markets on whether they're going to cut then or not. But I think the point is over the next 6 and 12 months, they'll probably continue to administer a handful of rate cuts and get that funds rate near 4% or maybe in the high threes. All right. And that's where they should be. I think that's the right path. That's what they're supposed to do. The problem is that's what's priced in, right? So right now, the markets are pricing in a funds rate that falls to about 3 5/8. All right. Over the next year. So it falls another, let's say, almost 100 basis points from here. Okay. And stops. And it never goes below that. So the markets are pricing in a very low probability of a funds rate that ever really falls below, 3.5 or 3 or 2.5% again over the next 10 years, right? So the markets have kind of priced in a persistence of this solid growth backdrop, of a sticky inflation backdrop, and of a high Fed funds world, right? And yes, that could happen. I mean, I hope that happens. We should all hope that happens because that's a really good environment. It means the economy's doing well. It means, your home price is doing well. Your equities are probably doing well. But, I've been in this business almost 40 years and things happen and they're typically unexpected, right? So I think the market's pricing in a funds rate of 3 5/8 forever is probably too high, right? So this gets us to long-term interest rates. So the 10-year right now is at 4.20. It hit almost 4.50. I've been kind of characterizing a 4 to 4.5% level on the 10-year as being the buy zone. Okay, you get to 4.5. I think you're supposed to be adding duration pretty aggressively, but anything in that 4 to 4.5, I think you're supposed to err on the side of having a little more duration rather than less. Okay, so you're kind of in the middle of that buy zone. I think 3.5 to 4 is what I would call long-term fair value. And that means that's a world where the funds rate, instead of averaging 3 5/8 for the next 10 years, it averages, 3 to 3.25. Okay, for the next 10 years. So that puts the funds, the 10-year treasury more in that 3.5 to 4% zone, which I think is fair value. But all right, that's fair value again in a pretty constructive world, right? Where the funds rate only gets down to 3 or 3.25. I mean, in 10 years, is something bad going to happen? Are we going to have a big risk off event? Yeah. Is it going to happen in 5 years? Probably. Will it happen in the next 3 years? Maybe, right? We don't know when and how recessions happen, but they happen and they tend to happen pretty quickly. And in that world, especially if you have that one handle inflation scenario, I mean, you could have the funds rate, 300 basis points too high, right? And in that world, the whole yield curve is 200 basis points lower than it is today. And that's an opportunity in fixed income, right? So that's what I really want to talk about, like bonds versus stocks. Where do we see value? The title of this webinar is Yield is Destiny. So the Bloomberg Aggregate Bond Index, which a lot of us use as our typical bond, our total return strategy, is run against the Bloomberg Aggregate Bond Index. It's yielding about 4 5/8 or 4 3/4 right now. Okay. And again, like I said, we're trying to beat that by about 150 on average annually. So that gives you an expected return of close to 6%. Okay. And we're yielding close to that, maybe a little bit less than that right now. Right. And yield is destiny. If you look at the history of that aggregate bond index, which is a really high quality, really liquid index comprised mostly of treasuries, government guaranteed agency mortgage backed securities, and very high quality investment grade corporate bonds, the historical yields are a really good predictor of the actual ex post returns over the next 5 and 10 years. And when you start at 465 yield, and I think rates are 50 to 100 basis points too high on average. So let's say they're 75 basis points too high. The duration of the AG is 6. So 75 times 6 is about 4.25 points. If that happens over 5 years, that's 80 basis points a year on top of that 460. So you get like almost 5.5% return on that index on average for 5 or maybe even 10 years, right? That's a really big number. And if you look at the current multiple and valuation on equities, for really the first time in probably a lot of your careers and in several cycles, the yield on the bond market is higher than the earnings yield on the stock market, right? And when you get to these points, the next 10 years tend to be a really good environment for fixed income. And you do have this correlation benefit today that you really haven't had a lot of in the last 10 or 15 years when interest rates were really low and they were just kind of poised to move higher and not provide that ballast, not provide a lot of upside if you have a big hard landing or a stock market correction, but you do today, right? And we've gone through decades. I mean, look at the early 2000s, the first decade of this century, right? Stocks did terrible because they were coming off, the tech bubble. Bonds did great. So you had a decade where bonds outperformed stocks. The next decade and change, stocks have done great and bonds have done terribly. So you've had these very different correlation environments over long periods. And now I think we're entering a decade where you can possibly see an equivalent return in fixed income as equities, maybe even higher, but certainly on a risk-adjusted basis, because bonds have about a quarter the volatility of stocks. I think it's a slam dunk that you'll get a higher Sharpe ratio or risk-adjusted return in fixed income versus equities for what that's worth. So I'm actually pretty bulled up on fixed income. I think the yield level is really attractive. I think the potential ballast or upside in bonds in a downturn in the economy or stock market is exaggerated right now because you do have that central bank that can really step in and provide a lot of support to the bond market. And they could also do more quantitative easing, right? I mean, their balance sheet is coming down quickly from 9 trillion to 8 to 7. It's probably going to get close to 6. And they have a lot of dry powder. And if you look at the size of that balance sheet at the Fed relative to the size of nominal GDP, that ratio has come down a lot. Again, because in my opening remarks, you see the denominator has gone up so much. So again, I think a really good backdrop for fixed income. But if rates never go down and just stay where they are, you're clipping a really high coupon, right? Let me touch on the credit markets quickly. It's really, this has been a tough one. I mean, I'm kind of pounding the table a little bit on the duration component. I think the Treasury yield, the government bond yields are high around the world. There is some premium built into Treasuries. Some people call it a credit premium, right? I mean, the US government has been downgraded a couple of times. Some people call it a supply premium. You see the giant sizes of these auctions that we issue every week. I mean, hundreds, tens and hundreds of billions of dollars. We're constantly issuing treasuries, and maybe the market has to get a higher yield to be able to absorb all that. But that is priced in to some extent. If you look at the treasury yield versus the yield on other similar risk-free rates. So look at interest rate swaps, right? Interest rate swaps in 30-year space. I know this is a little inside baseball, but they're trading about 75 basis points lower than the yield on 30-year treasuries. So if you're a big bond manager and manage pension plans like we do and insurance company assets and long-term assets for clients, and you want 30 years of duration, you can either sell bonds, raise cash, and go out and buy a 30-year treasury, at an auction, or you can just do a 30-year swap and get the exact same risk profile on, but you're giving up 75 basis points, right? So there's already this big premium built in. So that's a little bit of a preamble to the credit conditions, right? So the treasuries are cheap, but the credits aren't. All right. So if you look at the excess yield you get in investment grade corporate bonds relative to those treasuries, it's about 80 some odd basis points. It's getting really close to historical lows of excess spread. If you look at the high yield market, you're getting about 260 basis points, a little over 2.5% excess yield over that say 5-year treasury, right? That is almost at the bottom of the historical range. So you're kind of there in the credit markets, and it's hard to pound a table. So what we are doing in our portfolios, we've actually been adding duration at this higher level of rates. We're a little bit long right now versus the ag. The ag has a duration of 6. We're just a hair long of that, but looking really for opportunities to get longer, looking for signals where the economy is slowing, where maybe inflation is coming down, and maybe the Fed will finally realize that the funds rate is a little too high. And once you get that momentum, I think we would probably be more aggressive in adding some duration. But on the credit side, we've been going the other way. We've been reducing credit risk. We're about the lowest within our credit risk budget that we've been in my career here, right? And we've run between kind of 30%. So we have a risk budget. I mentioned that earlier for every different factor in fixed income, for rates, yield curve, currency, credit risk, industries, countries, issuers. We have dozens and dozens of risk thresholds for every portfolio. Within our credit risk budget, we're only using about a third of the budget. That means we have 2/3 of dry powder. Now that the range on that, since I've been running these funds for over 15 years, has been between about where it is now to about 110%. And we probably have averaged 70 or 80% of our credit risk budget. So we are really light on credit risk. And the way we've done that is we've moved up in quality. We've taken out, high yield. We've reduced our emerging market exposure. We've, been selling triple Bs to buy single As. We've been selling single A corporates to buy the senior debt of the banks, which in our minds are much more liquid and higher quality. We've been buying triple A asset-backed securities like collateralized loan obligations. Even some commercial mortgage-backed securities are structured with so much credit protection that they look really cheap to us. So upgrading the quality of the portfolio and moving in on the spread curve. So you sell a 30-year corporate to buy a 10-year, or you sell a 10-year to buy a 5-year, or you sell a 5-year to buy a 2-year. We call that a carry position, where we're kind of hunkered down in the front of the yield curve, not from a duration standpoint. Again, the interest rate measure is kind of independent. We're pretty neutral in duration and yield curve exposure across the curve. But in terms of credit risk, we're kind of hunkered down in short maturity, credit product, very high quality, very senior in the capital structure. And again, we're still earning a big yield advantage over the ag. So really like the way we're positioned, kind of hoping you get some risk off events like we had in early August, so we can step in and get more aggressive there. The one question I get almost every time I talk to our clients, and these are, big institutional, international pools of money in some cases, is what is going on with the federal budget, the federal deficit, the debt level at the US, right? And why aren't rates higher? And I touched on that a little bit. We're already getting penalized. That 75 basis point yield premium that it costs the Treasury and us as taxpayers every time the US Treasury issues a coupon bond, we are paying for that, right? And we're paying for the kind of the fiscal irresponsibility and the pretty poor outlook for reducing the budget deficit and reducing the debt over the next, years and decades. So there's this already kind of big premium baked into that. One reason I probably like higher quality bonds than lower quality bonds. But if you look at the debt situation, like what is the end game, right? Like how do you solve this problem, right? It's not the debt level that really, I think, is tips us into recession or into a fiscal crisis. I think it's the level of interest we spend every day, every month, every quarter, every year servicing that debt, right? If you look at the level of interest that the government is paying relative to either GDP or relative to the size of the budget, the size of our revenues, just look at it versus the size of our total government revenues, our tax revenues and other income. It was about 5% for many years. It's up to about 13 or 14% today. It's expected to go up into the mid 20s% just over the next decade or so. So if you just look at the level of debt, multiply it by the level of interest rates, it gets ugly really quickly, right? And I think that's the problem when the government has to start pulling money away, kind of crowding out valuable financial resources for supporting the economy just to service the debt, which is arguably an unproductive use of capital. Yeah, it helps certain people who own a lot of bonds, like your clients and bond folks like me, because we get more interest income, but it helps a lot of foreigners, right? The Chinese, the Japanese, the Europeans own a lot of our debt, right? So we're paying money, sending it out of the country, and it's not supporting the US economy. So I think at some point, again, I don't know what the trigger is, but at some point that level of debt service becomes so onerous and destructive to the financial resources of the government that it weighs on economic growth. And this has always been a philosophy of ours at PGIM Fixed Income. The more debt you have, the less you grow, right? And that's true at the federal level as much as for companies, right? They run into problems when they're over indebted, when they get to a kind of point of no return. So growth goes down, right? And what happens there? The Federal Reserve comes to the rescue. They say, all right, we need to support the economy. So they cut interest rates. Maybe they do some more quantitative easing, but ostensibly they're supporting the economy, but effectively they're bailing out the treasury, right? And at some point, the level of debt and the level of interest rates, something has to come down. And the level of debt is going to be really hard to turn that corner. I mean, who knows? Maybe, the DOGE, the new department in the federal government, and Ramaswamy and Musk, maybe they'll pull out a rabbit out of the hat and cut spending and get the deficit from 7% to 6 to 5 to 4. But man, that is really difficult to do when a huge percentage of the government spending is mandatory spending, and an increasing percentage of it is paying the interest on the debt, right? It really becomes problematic, and it becomes very difficult to cut a lot of expenditure. So it is a problem. It's unsustainable. But I think the solution is not the debt coming down as fast as the rates coming down, right? So the end game is, I think rates will be a lot lower than that 3 5/8 funds rate that's priced in forever right now. So it's not just the kind of the economic backdrop that gives me that kind of confidence in fixed income. It's the fact that at some point it just becomes untenable to service all this debt at these high rates, and the Fed will kind of come to the rescue ultimately. That's in my mind, that's the end game.